Welcome, market participants, to another Three Things in Credit. I'm Van Hester, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. There has obviously been a lot of attention paid over the past couple of months to credit cockroaches. Thank you, Jamie Dimon. We've reminded folks throughout that low-rated credit goes bust from time to time, and that's a good thing in a healthy economy. That's capitalism's creative destruction at work, clearing out companies with deficient business models and/or poor execution and/or inappropriate capital structures, the kinds of firms that, if propped up, degrade the competitive environment for more able competitors. Nancy Lazar of Piper Sandler put this phenomena in a succinct way this week. Would you rather have Amazon or JCPenney, Sears, and Kmart? Point well taken. This week our three things are: 1. Coming tailwinds. Sizable stimulus is set to hit in 2026. 2. Fed drama. It seeped into markets this week. Is it here to stay? And 3. Private credit update. Some weakness as you would expect, but surprising fundamental strength. We'll catch up with Bill Cox, KBRA's Chief Rating Officer, on the topic. All right, let's dig a bit deeper. Coming tailwinds. So the fourth quarter was supposed to be a soft patch economically, the time where growth was slowing under the full brunt of tariffs, inflation was hooking up, and consumer angst was growing over concerns related to job security and tighter credit conditions. All of that was expected to show up in a slowdown in corporate earnings, or at least guidance, increased credit cockroaches, and a rise in unemployment. And all of that was expected to show up in falling equity prices and widening credit spreads. So what happened? Well, we did get a dip in the price of risk related to credit cockroaches, but investors quickly got right back on board the risk train. Seems as though investors decided a handful of high-profile credits gone bad did not call into question normal, later in the cycle deterioration. And while survey data across both consumer and commercial sectors remain weak, corporate earnings have held up well, and future earnings estimate revisions are coming in decidedly positive, suggesting that the market's breadth is broadening. And then there is upcoming stimulus. Stimulus is on the way from 5 sources. 1. Infrastructure spending leftover from 2022's Infrastructure Investment and Jobs Act. 2. Tax cuts and breaks, courtesy of the One Big Beautiful Bill Act. 3. Interest rate cuts. 4. Deregulation. And 5. Affordability relief. Estimates for new spending from the soon-to-expire infrastructure bill are in the $100 to $150 billion ballpark. Big Beautiful Bill is expected to deliver $285 billion in tax cuts and breaks in 2026, split between businesses and consumers. The Fed Funds futures market sees another 2.5 25 basis point cuts in 2026. And look for a variety of programs aimed at improving affordability in the lead-up to 2026 midterm elections. We've already seen proposals for a $2,000 tariff dividend check. Don't be surprised to see some sort of housing incentives as well. And don't be surprised to see the price of gasoline fall due to increased supply. Ultimately, this will not be only stimulative, but inflationary. That will have to be addressed along the way and clearly poses a risk down the road. But over the near term, all of this will clearly be growth and credit positive. All right, on to our second thing, Fed drama. Will they, won't they, cut rates that is, or strike a hawkish tone in the presser, or forecast stronger growth in 26, or see Kevin Hassett as the next chair. Ordinarily, we don't get too worked up about Fed credibility or personnel changes. After all, the institution is data-driven, right? As an aside, what else would they be? Now, on the rate side, it's now broad consensus that the FOMC will cut the policy rate next week 25 basis points. This is consistent with what the Fed chair refers to as risk management, where the risks related to a no-jobs growth expansion exceeds those related to inflation, which for the time being seem to be behaving themselves, especially allowing for one-time price hikes related to tariffs. The market is forecasting between 2 and 3 additional cuts in 26. For what it's worth, we're in the 2 cuts camp, with risk skewed to the fewer side. As far as the summary of economic projections is concerned, we could see a modest bump to growth, taking into account all of the stimulus we outlined in the previous thing. We would not be surprised to see unemployment tick up a touch in 26 and quite possibly in the longer run estimate, due to immigration limits and employer caution driven by expectations for productivity gains. We could also see the longer run Fed funds rate bump up from September's projection of 3%. Now, as far as the next Fed chair goes, it will come as no surprise that the president will nominate someone who believes in and can make the case that rates are too restrictive. While that presumably introduces lots of concern as to Fed independence, we're not too worried. Monetary policy at the Fed is decided by committee and again is data driven. While I'm sure there will be lots of drama around certain FOMC member posturing and rhetoric, ultimately these people are fiercely independent. In the end, a divided FOMC may become the norm, but that is not likely to result in dramatically ideological rate decision outcomes, in our opinion. All right, on to our third thing, private credit data update. Joining me today is Bill Cox, KBRA's Chief Rating Officer. Bill, let's jump right in. Last week, we hosted a webinar titled Private Credit Update, Cockroaches, the FT, and Rising Defaults, how KBRA's data can help you deal with each. What were the key messages?
Hi, Van. I'd say there are three key messages. First, some of the public reporting about problems in private credit missed the mark, in our opinion. The unfortunate thing is that this reporting has caused a distraction from where we see some real issues and pressures beginning to emerge in private credit. So, to be clear, before I jump into those issues, we do not see private credit as contributing to systemic risk. We do not see the insurance industry as an over invested player in private credit. And we certainly don't believe that the recent large defaults in debt markets had much to do, if anything at all, with the private credit market. So that's the first point. The second point is there are pressures building. There are a combination of factors contributing to these pressures, and they include rising defaults among some middle market leverage borrowers. We see tightening spreads for new middle market loans. We see delayed exits in private equity portfolios due to valuation uncertainty and other factors, which is contributing to fewer investment options for some private credit platforms, especially in light of the amount of money they've raised in recent years. And we've seen these conditions begin to influence some portfolio managers' decision making. Again, not everywhere, but we are seeing some managers make bigger bets on riskier positions because of these conditions than they had planned or we had anticipated. A third point I'd like to communicate directly to investors is that we think there will be greater pressure on returns on average, but certainly greater divergence of return performance, and all coming at the same time the industry is pivoting towards expansion. So, to be very clear, we see rising defaults in underlying borrowers, but we do not see the emergence of defaults or excessive credit pressures on rated products, rated transactions, and entities. However, if you're going to be watching for something that is caused by these conditions, it would be a divergence of return performance amongst private credit funds and platforms. And this is all happening at the time that there is both collateral type expansion, geographic expansion, and investor type expansion, including into retail channels, which is bringing with it more regulatory scrutiny.
All right, let's talk about KBRA's data. Private credit, if I believe press reports, is notoriously opaque. Describe the breadth and depth of our private credit data.
Yeah, it's a great question. And to be clear, it is not opaque to us. When we are rating a transaction, private or public, we're seeing the same level and depth of information that we would need in any context. We have now hundreds of ratings of middle market CLOs, of feeder nets into private credit strategies, of credit facilities that leverage those private credit strategies, dozens of BDCs, and we also rate dozens of NAV facilities and CFOs, a relatively new asset class. For many of those ratings, we develop credit assessments for underlying positions, underlying borrowers or private equity position, meaning we receive multiple years of financial statements, loan agreements, internal credit memos, and often ongoing updates of all of those things. So that portfolio of underlying assets now consists of over 2,200 unique borrowers and over $1 trillion of middle market private debt. And those borrowers are a really good representation of the industry, both in terms of size and this underlying sectors that the private credit market serves.
Thanks for that, Bill. That's certainly useful context. Now, we just published our latest middle market borrower surveillance compendium. What does our data show and what trends are we watching develop?
Yeah, the good news is that for most companies and on average across the whole portfolio, revenue and EBITDA growth continues to be robust. It's moderated slightly, 13% and 29% respectively in the last 12 months. But despite the fact that this growth has moderated, it's fairly consistent across all sectors and company sizes. Having said that, there are also rising incidences of default across this landscape, still small amounts relative to the high yield or BSL markets, but we think that gap is going to be closing in the coming months. Among the middle market borrowers, downgrades have outpaced upgrades for 7 consecutive quarters. Again, a leading indicator of what is on the horizon. And that has resulted in a record count of obligors that KBRA has assessed at the triple C minus level, which for us means essentially in default, but for not having made a payment default as yet. So, to enhance transparency around the stress levels that are on the horizon, this quarter we introduced the KBRA Middle Market Default Monitor, which consolidates borrowers who are already in payment default, as well as those that we believe are inevitably going to cross that line into payment default because of other pressures that we see in this fundamental data. In the last 12 months, by count, this monitor indicates that 3.5% of the portfolio is essentially in default and 2.1% by notional amount. We expect this monitor to rise modestly in 2026, reflecting our view that some of these borrowers will not be able to back out of the weakened conditions that they are currently experiencing. We're seeing pockets of weakness becoming more evident in some sectors, looking at those sectors that include more volatile areas such as consumer retail, but we're also seeing it in casinos, hotels, leisure, entertainment, and portions of the healthcare roll up industry, which is something that we have written about recently.
Terrific. Thanks for that, Bill. Now, to get a hold of this report and everything else we publish on private credit, go to our website, kbra.com, and click on the Private Credit tab. So there you have it. 3 things in credit. 1, coming tailwinds. Look for a boost to growth and inflation. 2, Fed drama. How much of it really matters? Well, not much. And 3, private credit data update. Some weakness, as you would expect, but surprising fundamental strength. And as always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.